Time for business news now with Will Edwards. Will, so we're going to start right here in France with a controversial government effort to save jobs in industry.
Yeah, the government made it to a deadline on Friday night to save a steelworks in northwest France, but it's come at rather a heavy cost. The Industrial Renewal Minister has managed to offend quite a large proportion of the business community, saying that ArcelorMittal, the company involved, is not welcome in France, despite the fact that they are now going to continue running this plant. And he also threatened nationalisation, while despite the fact that over 600 jobs have been saved, even the unions don't seem to be happy with the deal. Let's take a look.
There will be no immediate job losses at the Florange steel plant, but there was no celebration among the workers as they heard the news at the weekend.
The only alternative, the only solution possible was nationalisation.
That was the threat that was hanging over ArcelorMittal if the steel giant kept to its plan of permanently closing the blast furnaces and making over 600 employees redundant. To avoid a state takeover, boss ArcelorMittal has now dropped that idea and instead promises to invest €180 million over the next 5 years. But unions have expressed their scepticism, as have local politicians.
I have huge doubts in ArcelorMittal, and I'm afraid that once again he has fooled the French government because he has never kept his promises.
I have to ask myself how trustworthy the words of ArcelorMittal are. He's always making announcements, announcing investments, but not keeping his promises.
The French ecology minister has also said she has no confidence in ArcelorMittal, and even the Minister for Industrial Renewal, who was one of the lead negotiators in the deal, has blasted ArcelorMittal for reneging on earlier promises and humiliating European governments. The minister had earlier accused the steel tycoon of blackmailing France. The government says nationalisation is still on the table if ArcelorMittal fails to hold up its end of the bargain.
Will, on the other side of the channel, the British government is also facing economic difficulties.
Yep, just because they're not in the Eurozone doesn't mean things are any easier for them. George Osborne, the finance minister, said that it's going to take longer than expected to fix the economy. The government is now expected to miss its target of getting national debt coming down by 2015. It's probably still going to be going upwards at that point. But the Chancellor said it's too late to turn back on austerity plans now, which the opposition want to do. Let's take a listen to his defence.
It's clearly taking longer to deal with Britain's debts. It's clearly taking longer to recover from the financial crisis than anyone would have hoped. But we've made real progress. The deficit is down by a quarter. There are 1 million more jobs in the private sector. And to turn back now, to go back to the borrowing and the debt and the spending that Ed Balls represents would be a complete disaster for our country.
So, Will, if Britain wants to reduce its debt, they might be interested in raising more tax revenue. And there's a report on that out just today.
That's right. MPs are publishing a report on multinational tax arrangements. This is after quite a bit of controversy in the last few weeks over how much big companies actually end up paying in the UK. Of course, they can move a lot of their operations offshore. Now, Amazon, you can see there, they're paying less than 1% on their €250 million of turnover that they made in the UK because they managed to move those profits offshore, therefore avoiding UK taxes. Now, members of Parliament are publishing this report, which recommends more being done by the tax authorities themselves, but it also says the companies are undertaking immoral tax evasion, they call it. Not, of course, illegal, though.
So what's going to be done about this?
Well, they are going to be giving the Inland Revenue Service, the tax authorities, £77 million more to do their job more effectively. That should go a long way, and they reckon they'll make £2 billion more out of that £77 million investment. So, should be a sound investment, they reckon. It also says, the UK government says, that they're going to close loopholes, and they're hoping to work internationally across borders. Particularly France and Germany have been working with the UK on this front, and the UK is leading the G8 next year. They're hoping to push for more international legislation on this front.
What's the news from the markets?
Well, a bit more of a mixed picture than we were seeing earlier. There has been a survey of manufacturing confidence in China, which was more positive than expected, slightly averting fears that things are slowing down in China. But you can see there the Hang Seng has now followed the way of the Shanghai Composite. Worries about the US fiscal cliff still not being averted. We'll be taking a look at that in a minute.
Now, while much of Europe languishes in recession, Germany has managed to weather the economic crisis better than most. But the continent's largest economy is nonetheless beginning to suffer a slowdown. Let's take a look.
Germany is one of the few Western countries not due to suffer recession or stagnation next year. But that's not to say its economy is without weaknesses. Its main trading partners are in the Eurozone. But with the ongoing debt crisis, Spain, Italy, France, and even non-Euro member Britain are buying fewer German goods. As a result, exports have fallen by more than 9% in 1 year. In order to keep its economic motor humming, Germany is turning ever more decisively towards Asia, particularly China. Nonetheless, growth forecasts for 2013 have been revised downwards, from 1.6% to just 1%. That figure is still noticeably healthier than many of Germany's European neighbours. France is predicting growth next year of a mere 0.3%. Unemployment in Germany remains low at just 6.5%, partly because of flexible working conditions and efforts to avoid the wage inflation seen in other Eurozone members throughout the past decade. One worry for German leaders is the high level of national debt. It stands at more than 2 trillion euros, or 80% of GDP. Not as big as Italy's perhaps, but still one of the highest in the EU, and not helpful when Germany seeks to give lessons to others on budgetary discipline.
Well, if we look at the U.S. now, we keep talking about this fiscal cliff. What's the latest on that? Has there been any back and forth between Republicans and Democrats this weekend? I believe there has.
There's been a lot of back and forth, but there hasn't been too much movement. We've been hearing just a minute ago how the markets aren't reacting too well to the fact that there's no agreement still, and the date is getting ever closer. January the 1st is when automatic tax cuts and spending cuts and tax rises are going to kick in unless some sort of compromise is found in Congress. The only problem is Republicans don't believe in adding tax rises, which is what the Democrats want, and similarly, the Democrats themselves aren't keen on spending cuts, which is what the Republicans want to see. So that's the nub of the problem. Let's hear how politicians from both sides of the aisle have been reacting to talks over the weekend. Firstly, Timothy Geithner. He's representing President Obama's views on this, and he's talking about his Republican opponents. Let's take a listen.
We're still a bit apart, and they're going to have to move further, and then try to figure out again what they do next in this context. But again, we've given them a very detailed, comprehensive set of proposals. We're open to suggestions on how to do it differently. If they want to come back to us and say, we'd like you to do this differently, do more of this, then they should lay that out for us.
I think we're going over the cliff. It's pretty clear to me they've made a political calculation. This offer doesn't remotely deal with entitlement reform in a way to save Medicare and Medicaid and Social Security from imminent bankruptcy. It raises $1.6 trillion on job creators that will destroy the economy, and there are no spending controls.
So two rather different views there. One saying they're coming closer and closer together, the other saying we're going to drop off the end of this fiscal cliff. Barack Obama over the weekend saying that if they don't come to an agreement very soon, they're going to have a Scrooge Christmas, basically a Christmas without a turkey on the table for the US.
Will Edwards, thank you very much. You keep bringing us the good business news. We'll see you later on this morning. Thanks a lot. Thank you for watching. Stuart Norville is up in just a few minutes.